The Nigerian economy advanced 2.1% year-on-year in the fourth quarter of 2015, slowing from a 2.84% expansion in the previous period and below market expectations of a 2.6% increase. It is the lowest growth rate in 16 years as lower oil prices keep hurting the oil sector, dragging government revenues down and weakening the naira. Joining me to discuss this is USORO ESSIEN, an economist and research head at Greenwich Trust. And also joining the discussion is ADEGBOYEGA OLATUNDE, the head of research at Btva Media. So I'm going to start with you.
Thank you.
The oil constitutes about 8.9% of the GDP at the moment. And yes, we're talking about the drop in oil prices. But looking at the non-oil sector and the decline in that growth, I mean, the decline was quite steep. What is happening there?
Well, the decline was largely expected, even though, as you largely said, the non-oil sector is about 91%. Most of the revenues, apparently, and the revenues is what brings capital in and also liquidity around, come from the oil sector. So a decline in price, which is really the factor that we should consider, because production has stayed stable around 2.1 million barrels per day. A decline in price will reduce government revenues, and spending, aggregate spending for the Nigerian economy is largely led by government spending. So when government spending reduces that significantly, you will see a lot of effects on certain sectors, particularly manufacturing, and also sectors that are driven by government spending. So what we did see also was, one, an effect from that, and two, we saw a bit of odd policy choices by the government. One was a slowdown in putting their fiscal team, their FEC team, in place, which came in November. So largely, we lost half of that quarter just for uncertainty. And the second was the FX restrictions.
All right.
So if you look at some of the sector breakdowns, you see that some sectors actually slowed down to the negative point, and that's in manufacturing.
Okay.
So,
let me just quickly latch onto the policies.
Okay.
The Q4 is historically a great month. It's always the best quarter out of the other quarters. Yeah. But then we see it's the worst quarter for this year. I mean, from the 2.34 we had in the second quarter, we're sitting on 2.1% for the fourth quarter. Yeah. And apparently, the non-oil sector picked up a little bit. If not, that would have even worsened the index even lower. So do you think the policy had so much of an impact to have dragged the numbers down? Okay,
well, GDP, let's look at it from expenditure, right? The government has an import substitution policy. That's the clearest or the closest thing I can akin to what we are seeing. And their view is to restrict FX, and that will reduce the import bill. However, they are doing it at a very steep cost. The cost is reducing consumer demand, because you are not substituting. You don't have the capacity to substitute several of these goods. And if you want to make the price exorbitant by getting that demand met through the black market, it means that a lot of people not sure of the direction would would reduce the expenditure for a period of time, hoping there will be clarity going forward. So what you did see was aggregate spending during that period reduced. So a lot of money was left in pockets, and there are statistics to support this. You look at banking liquidity from Q4 last year up until Q1 now. Go to the interbank window, you would see that banks are not lending. They are not lending to the real sector. Credit is not moving, and if credit is not moving, especially to the real sector, consumer spending will cripple. And it's a dangerous trend, because for an economy that has been growing at the rate of an average of 5 to 6%, if you want to stifle demand by what I would call crude policies, you may not achieve your growth rates. All right. For the next 2, 3, 4 years.
Okay, Boyega, let me quickly come to you. USORO is of the opinion that capital controls is hindering demand. What is your take on this, and what is the way forward?
I believe I support his argument that it's actually hindering demand. Look at it from CBN's purchasing manufacturers index, for instance. Now, that dropped by 1.7%. Now, if you look at the production subsector, it dropped the steepest, which was about 4.3%. So that basically shows you that your capital control policy currently is hindering production, where basically I have to source a huge proportion of my input costs at the official markets, and I'm getting 5% or less than 5% of the amount of dollars I need to do that, and they're not readily available substitutes locally, then I am basically left to the forces of demand and supply to continue producing. And at some point, the government has to, we hear that they're calling for a roundtable to debate alternatives to devaluation. But the fact is there has to be some type of clarity regarding that policy. I've always said that if you're paying 300 naira already, now the naira has been devalued already, whether the government does it officially or not.
All right, sir, tell me something. So are you of the opinion that, yes, that there's a drop in oil prices, but you feel like the ripple effect of a drop in oil prices is overstated, and in actual fact, it could be some policies that is driving the low growth that we're currently seeing? Okay,
well, for growth to happen, two things have to happen. There must be cash moving, and then people must be willing to spend. The issue is not whether people have enough discretionary spend. The issue is, do they want to spend at the prices they are seeing, or with the opportunities that are presenting themselves? The government has not been firm, or has not been able to, give a certain level of confidence as to how long they can hold the current policy in place, or a certain kind of trajectory. We don't have forwards for 6 months. We don't have forwards for 12 months. We don't have forwards for 18 months for pricing. You need that stability. The devaluation is not the issue. The issue is stability and liquidity for business to continue going on. Look at your trade. It has dropped. Look at your capital importation. Both FPI and FPI dropped by about 50%, the highest. So those are clear signs that business activity has not just slowed down, but it's partially closing up in some sectors. So that has to be cleared. You have to let individuals, investors especially, know what kind of environment they can invest in and what to expect. You can't allow the uncertainty. The uncertainty is just too much.
All right, so now we're talking about investors' confidence, we're talking about stability. Boyega, there's always a time lag between action and results, and I don't see anything different between what we've happened in Q4 2014 and what is currently happening. What can we predict for the Q1 2016?
I think it's going to drop further. It was 2.11 in Q4. I think it's going to drop further because, as you rightly said, the CBN has already alluded to it with the fact that the PMI has dropped. So the PMI is representative of manufacturing. You might have some, where it's dropped regarding manufacturing, you might have some type of stability simply because oil prices have rallied above 38 for the first time in a while. But ultimately, I still feel it will be about 2%.
2%?
Yeah, about 2.
What are you predicting for the Q1 GDP 2016?
For Q1, we penciled 2.3. And why we did that is because of, there will be a bit, it should be lower, but because of the rebased year figure, you have a slightly low base year figure since the rebasing of GDP. So that will prop Q1 a bit,
That'll prop Q1 a bit. So now, if you were the CBN, if you were the president of Nigeria, if you were the CBN governor, what are you going to do differently for us to drive these numbers? We're moving from an average of 5.5% over the past 10 years, and we've seen the lowest low in 16 years. What are we doing differently?
Well, there are two or three things I would do. The first thing I would want is the budget, ambitious as it may be, it needs to be passed. You cannot have that level of capital expenditure expected locked up in a bill. That needs to be passed before the end of Q1 because the items there have a long gestation period for you to see growth. If that is unlocked, you have about 400 billion there, 300 and something billion there, earmarked for 3 key sectors: power, housing, and works. And that you would see that spur a lot of activity if it's implemented properly. You also do not want to kill the efforts that the last regime had in Agric. Agric is still the flagship of these GDP figures we're seeing, and that has to be addressed. You have to make sure that liquidity and the soft loans that we're going to farmers and the fertilizer program is kept up. And you also try to look at increasing productivity there really quickly, because those are sectors you can actually boost they're quick wins that can help boost your import substitution that
All
you're
right,
looking
fantastic.
at.
So we're looking at quick wins past the budget, flood the market, let the key sectors start getting into effect.
Yeah.
All right, thank you so much, Boyega, for joining us.
You forgot to add clarity in your exchange rate, policies, which would go some way in augmenting back inflows, at least dollar inflows into the economy.
All right. Thank you, sir, and thank you, Boyega.
Okay.
After the break, it is more Business Nigeria. Stay with us.